Are you tired of feeling lost and
What?
confused every time you read financial news articles or try to make sense of the social media posts about stocks? Well, in
Bruh.
this video, we'll cover some of the most commonly used terms in the stock market so you can feel confident in your understanding of what's happening in the financial world. I'm Matt from PB University, and you guessed it, this is our stock market terminology class. Before we start, make sure to check out the description of this video for the handout for this class. All right, first let's start with the concept of a bull market. A bull market is a period of time in which stock prices are generally rising and investors are optimistic about the future of the market. On the other hand, a bear market is a period of time in which stock prices are generally declining and investors are pessimistic about the market's future. So bull up, bear down. Another important term to understand is dividend. A dividend is a payment made by a company to its shareholders, usually in the form of cash or additional shares of stock. Dividends can be a good source of income for investors, but it's important to note that not all companies are required to pay dividends, and they may require to instead reinvest profits back into the business. Now let's move on to some other important stock terms. Outstanding shares. Outstanding shares refer to the number of shares of a particular stock that are owned by all shareholders, including restricted shares, which are shares owned by insiders or large shareholders, and free-floating shares, which are shares available for public trading. The total number of outstanding shares can affect the price of a stock, as a larger number of outstanding shares may dilute the value of each individual share. Stock split. A stock split is a corporate action in which a company increases the number of outstanding shares of its stock by issuing more shares to current shareholders. This can be done to make the stock more affordable for individual investors or to increase the liquidity of the stock. Initial public offering, or IPO. An IPO is the first time that a company's stock is made available for purchase by the general public. Blue chip stocks. Blue chip stocks are stocks of well-established companies with a long track record of stability, reliability, and strong performance. These stocks are often considered to be a safe investment. Growth stocks. Growth stocks are stocks of companies that are expected to grow at a faster rate than the overall market. These stocks may be riskier, but they also have the potential for higher returns. Value stocks. Value stocks are stocks of a company that are trading at a lower price compared to their intrinsic value, as determined by fundamental analysis. Investors who buy stocks are hoping to capitalize on the undervalued price and realize a profit when the stock's price eventually rises to its true value. Index fund. An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks the performance of a specific market index, such as the S&P 500. Stock market index. A stock market index is a statistical measure of the change in the value of a portfolio of stocks, representing a particular market or market sector. Some well-known indices include the Dow Jones and the S&P 500. Sector. A sector is a group of companies in the same industry, such as technology or healthcare. Market capitalization. Market capitalization, also known as market cap, is the total value of a company's outstanding shares of stock. It is calculated by multiplying the company's stock price by the number of shares outstanding. Earnings per share, or EPS. Earnings per share is a company's profit divided by the number of outstanding shares of a stock. It is used to determine the profitability of a company. Price to earnings ratio, or PDE ratio. The price to earnings ratio is a measure of a company's stock price relative to its earnings per share. It is calculated by dividing the stock price by the EPS, which, as we know, is the earnings per share. Return on investment. Return on investment, or ROI, is a measure of the profitability of an investment, calculated by dividing the profit by the cost of the investment. So, for example, if an investment of $100 generates a profit of $20, the ROI is 20%. Short selling. Short selling, also known as shorting, is the practice of selling a stock that the seller does not own, with the hope of buying it back at a lower price in the future. Margin. Margin is the use of borrowed money to buy securities such as stocks. It allows investors to potentially amplify the returns, but it also increases the risk of losses. Bonds. Bonds are debt securities issued by corporations or governments to raise capital. They pay periodic interest to bondholders and return the principal when the bond matures. Yield. Yield is return on an investment, expressed as a percentage of the investment's cost. So for example, if a bond with a face value of $100 pays $5 in annual interest, its yield is 5%. Stop loss order. A stop loss order is an order placed with a broker to sell a stock if it reaches a certain price, with the goal of limiting potential losses. Limit order. A limit order is an order to buy or sell a stock at a certain price or better. Market order. A market order is an order to buy or sell a stock at the best available price. Now let's move on to some advanced stock market terms. Derivatives. Derivatives are financial instruments whose value is derived from the value of an underlying asset. Examples of derivatives include futures contracts and options. Futures contracts. A futures contract is a standardized agreement to buy or sell a specific asset at a predetermined price at a specified time in the future. Options. Options are financial contracts that give the holder the right, but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. Hedge fund. A hedge fund is an investment fund that uses a variety of strategies, including the use of derivatives, to generate returns for its investors. Hedge funds are typically only available to accredited investors and are known for their high risk and potentially high return. PBU. PBU stands for Pennybois University, our extensive stock trading education program. Alright, that's enough stock terms for now. You can check out my other videos for more, as well as more in-depth analysis on all these terms and the stock market as a whole. Also, make sure to check out the rest of our free trading classes. I'll leave a link to that in the description of this video. I hope this helped you gain a better understanding of these important stock market terms. As you continue to learn about investing, it's important to keep expanding your knowledge and staying up to date on the latest developments in the financial world. So, make sure to check out all of our live streams, educational programs, and alerts in the Pennybois Stock Alerts Discord. We also have crypto, OTC trading, and NFT education as well. I hope to see you there, but as always, until then, I hope that you all make some bread.